All right, so get this. We're going deep on stock taxes today.
Oh, yeah.
And, I know, right?
Everyone's
Taxes.
favorite topic.
But, we got to do it right. So we've got some amazing sources that you, the listeners, have sent in.
This is going to be good.
It is covering everything from capital gains, dividends, stock options.
Oh, and don't forget those tricky little rules.
Exactly, like the wash sale rule.
Sneaky.
So sneaky. But you know what the real goal here is today? I want to give everyone listening some real tools and strategies they can use.
Yes. Actionable stuff.
Yeah, so we can all minimize those taxes, keep more of our money, right?
Absolutely. And, one thing that really stood out to me from the stuff you sent over was the idea of being proactive.
Oh, interesting.
Like, it's not just about waiting till tax season and freaking out.
Oh, I know that feeling.
It's about making smart decisions all year round that can impact how much you end up owing.
Love it.
Right.
Okay, so let's start with what seems to be the foundation of stock taxes capital gains.
The big one.
Right, and the sources are all over this difference between short-term and long-term gains.
Holding period is key.
Yeah, and how that holding period can totally change your tax rate.
Big time.
Okay, so spill the tea. Back in the 1920s, short-term gains were actually taxed higher than regular income.
Yeah. They were trying to, calm down the market. Curb all that speculation, get people to invest for the long haul.
Huh, I had no clue. So besides, trying to chill out the roaring 20s,
Right.
why does the tax code still favor long-term gains?
Well, there are a few ideas floating around out there. Some folks say it helps stabilize things, Long-term investors are less likely to panic and sell when things get a little rocky.
Makes sense.
Others argue it's about rewarding those who are truly committed to a company's growth, not just in it for a quick buck.
Yeah, I can see that. But for someone who's new to all this tax stuff, how much of a difference are we really talking? If I hold a stock for 11 months versus 13 months, doesn't matter that much.
You would be surprised. Let's say you're in the 22% tax bracket and make a $10,000 profit from a stock you only held for 11 months.
Oh.
Uncle Sam's going to want $2,200 of that.
Ouch.
But hold on to that same stock for just 2 more months so it becomes a long-term gain. Your tax rate could drop to 15%.
Wow.
You've only owed $1,500. That's a $700 difference.
Okay, that's a whole extra weekend getaway right there.
You got it. And remember, those savings get even bigger if you're in a higher tax bracket.
Okay, so now I get it. It pays to be patient, literally.
Right.
So does that mean the best strategy is always just to hold on to your stocks forever?
Well, in general, yes.
Mm-hmm.
But there are some situations where selling sooner might actually be a good move.
Okay, like what?
Tax loss harvesting is a good example.
Right.
If you've got some stocks that are down, selling them before the year ends lets you use those losses to offset any gains you might have made.
Interesting.
It can potentially lower your overall tax bill.
So it's like strategically using your losses to your advantage.
Exactly.
Yeah.
Turning that frown upside down.
Yeah. Okay, so capital gains. Check. What about dividends? Those are like payments companies give to shareholders, right? But I've noticed they sometimes get taxed differently than regular income.
Yep, you're on the right track.
So what's the deal with that?
It depends if they are qualified or ordinary dividends.
Okay, I'm listening.
And just like with capital gains, there's a little incentive built in for certain investments.
Interesting. Break it down for me. What makes a dividend qualified and why should we care?
So to be qualified, the main thing is that you've held onto the stock for a certain amount of time, usually more than 60 days.
So there's a holding period for dividends too, not just when you sell the stock.
You got it. It's all about encouraging that long-term investment mindset.
And why should we care?
Well, because qualified dividends get that sweet tax treatment, 0%, 15%, or 20% depending on your income. Ordinary dividends get taxed as regular income, which could be a much higher rate.
Okay, so let me get this straight. If I'm thinking about buying a stock that pays dividends, I should consider how long I'm going to hold on to it and whether those dividends are going to be qualified.
Exactly, because that could make a big difference when it's time to pay those taxes.
Got it. It's all about the strategy.
Always.
Oh, before we move on from dividends, the sources mentioned dividend reinvestment plans or DRIPs. What are those?
Oh, yeah. DRIPs are a great way to automate your investments and potentially lower your taxes over time.
Okay, I'm intrigued. How do they work?
So instead of getting your dividends as cash, they're automatically used to buy more of the same stock.
So your investment just keeps growing.
Exactly. That's the power of compounding. Plus, it can help you out on the tax side, too.
How so?
Well, remember how important the long-term holding period is for those lower capital gains rates. With a DRIP, you're basically extending your holding period every time dividends get reinvested.
Oh, I see.
It's like a sneaky way to increase your holding time without even thinking about it.
So you're racking up those long-term gains without lifting a finger.
Pretty much. It's
That's
one of those hidden perks of DRIPs that many people don't even know about.
pretty cool. Okay, so that's dividends. Pretty straightforward.
Mostly, yeah.
Let's move on to something that always seemed kind of mysterious to me. Stock options.
Oh, yeah.
I know some people get them as part of their compensation package, but honestly, the whole thing seems a bit complicated.
They can be, but they're not as scary as you might think.
Break it down for me.
Okay, so a stock option basically gives you the right to buy company stock at a set price, called the strike price, sometime in the future.
So if the stock price goes up, you can buy it at that lower price.
Exactly, like a little bet on the company doing well.
Makes sense. What about taxes, though? Is it all taxed the same?
That's where it gets interesting. We've got two main types of stock options: non-qualified stock options, NSOs, and incentive stock options, or ISOs.
NSOs and ISOs, and those are taxed differently.
Yes, indeed, which it can make things a bit tricky.
All right, so NSOs versus ISOs. What's the main difference?
With NSOs, it's pretty simple. When you exercise the option, meaning you actually buy those shares, the difference between the strike price and the market price is considered income,
Okay,
and it gets taxed as regular income for that year.
got it. So it's like a bonus from work.
Exactly. Taxed just like your salary.
Okay, that makes sense.
Yeah.
So ISOs, what makes them so special?
Now, ISOs are where it gets a little more nuanced.
Nuance, I like it.
Potentially better from a tax standpoint,
Yeah.
but also potentially more complicated. The key difference is you generally don't owe taxes when you exercise the option.
Really? So you could buy those shares at a much lower price than they're worth and no taxes right away.
Exactly.
Yeah,
That's
that
the big draw with ISOs.
sounds great.
But, and it's a big but, you do have to pay taxes eventually
Okay, when?
when you sell the shares.
So it's like delaying the taxes until later. But is that always a good thing? I mean, what if tax rates are higher when you sell?
That's a really smart point, and that's where the strategy comes in. If you think tax rates are going up, it might not be a good idea to delay those taxes.
I see.
But if you think they'll stay the same or go down, delaying could save you some money.
So you're basically gambling on future tax policy.
In a way, yes,
ISOs are tricky.
definitely. Plus, there's another thing to consider with ISOs, something called the Alternative Minimum Tax, or AMT.
AMT, that doesn't sound good.
Not always, no. The AMT is kind of like a parallel tax system with its own rules and rates.
Okay, so how does that relate to ISOs?
So when you exercise an ISO, even though you're not paying regular income tax right then and there, that profit, that difference between the strike price and the market price, can trigger the AMT.
So even though you're not technically paying taxes yet, it could still increase your overall tax bill.
Exactly. It's like the AMT is keeping tabs, saying, hey, don't forget about us.
Okay, stock options, got it. Definitely more complex than I thought.
For sure.
Before we move on to strategies for actually minimizing stock taxes, which I'm excited about,
Me too.
the sources mention a couple of those gotchas we should watch out for. First up, the wash sale rule.
Oh, yeah, sneaky.
So sneaky. What's that all about?
So imagine you have a stock that's losing money.
Oof.
You decide to sell it, so you can claim that loss on your taxes.
Makes sense, right?
Seems smart, but the IRS isn't too fond of that trick. The wash sale rule says if you sell a stock at a loss and buy back the same stock, or even something really similar, within 30 days before or after, you can't claim that loss.
What? So I can't sell a stock that's down and immediately buy it back?
Nope. The IRS sees that as trying to manipulate the system for a tax break.
Hmm.
They want to make sure that when you claim a loss, it's a genuine loss, not just a temporary thing.
So if I'm going to sell a stock at a loss to, get that tax benefit, I need to be absolutely sure I'm done with that stock for at least 30 days.
To avoid the wrath of the wash sale rule, think strategically about your moves, especially when you're trying to harvest those losses.
Okay, wash sale rule, got it. What about that NIT thing?
Yes, the net investment income tax.
What's that about?
This one mostly affects people with higher incomes.
Okay, how high are we talking?
According to your sources, if your modified adjusted gross income is above $250,000 for married couples filing jointly, or $200,000 for single filers, you'll have to pay the NIT.
So for those high earners, what does the NIT mean for their stock investments?
Well, it means you'll pay an extra 3.8% tax on certain types of investment income, including dividends and capital gains.
So even with those lower rates for qualified dividends and long-term gains we talked about, the NIT could add a bit back on top.
Unfortunately, yes. Something to definitely keep in mind.
Okay, it's a tax maze out there.
You could say that.
But the good news is the sources also talk about ways to minimize our tax burden, right?
Absolutely. And that's where it gets really interesting. By understanding the rules and planning ahead, you can potentially keep more of your money.
Okay, let's hear it. What are some of these powerful weapons in the fight against stock taxes?
Well, we've already talked about holding for the long term and tax loss harvesting. But the biggest weapon in your arsenal is tax-advantaged accounts.
Ooh, those sound good. Tell me more.
We're talking about Roth IRAs, traditional IRAs, 401ks, and even health savings accounts, HSAs.
Lots of acronyms.
Each of those offers unique tax advantages that can seriously reduce your taxes, both now and in the future.
Okay, before we dive into each type of account, why are these accounts so tax advantaged? What makes them different from just a regular brokerage account?
It comes down to how your contributions, earnings, and withdrawals are treated for taxes. With regular brokerage accounts, you usually pay taxes on your investment income every year. But with these special accounts, you get breaks either upfront, along the way, or when you finally take the money out.
Okay, so let's start with Roth IRAs. What's so great about them?
Roth IRAs are fantastic for long-term growth, especially for younger investors just starting out. The big thing is, while you contribute after-tax money, meaning you don't get a deduction right away, all those future earnings and withdrawals in retirement are completely tax-free.
Wait, completely tax-free?
No taxes. Imagine that. Let your investments grow for decades, and when you're ready to enjoy that money in retirement, Uncle Sam doesn't get a cent.
Okay, I'm sold. What about those other accounts? Traditional IRAs and 401ks.
Those are great options too, especially if you want to lower your tax bill right now.
Always a good thing.
Right. With traditional IRAs and 401ks, your contributions are made before taxes, which means you get a deduction on your income taxes for this year.
Nice.
Plus, your money grows tax deferred, meaning you don't owe any taxes until you take it out in retirement.
So basically, you get a break now and pay later when you're probably in a lower tax bracket anyway.
You got it. Smart move, right?
Very smart. All right, and finally, HSAs. I know those are for medical expenses.
Yep.
But the sources mention some tax advantages there too.
Absolutely. HSAs are unique because they offer a triple tax advantage. Contributions are tax deductible, your money grows tax-free, and withdrawals for qualified medical expenses are also tax-free.
Wow, triple tax-free. So even if I'm healthy right now, it makes sense to contribute to an HSA if I can, right?
It's definitely a good idea. It's a tax break while also saving for future healthcare costs. And if you don't end up using it for medical expenses, you can take the money out after age 65 for anything.
Oh, wow.
You have to pay taxes then, just like a traditional IRA.
So lots of options.
We've got Roth IRAs, traditional IRAs, 401ks, and HSAs. Something for every situation.
Amazing. Okay, so we've got all these tax-advantaged accounts to choose from. That's great.
And those are just the tip of the iceberg.
Hold on, my head is spinning.
I know, it's a lot.
Maybe we need a little break before we dive into even more strategies.
Good idea.
But before we do, any words of wisdom for those who might be feeling a little overwhelmed by all this tax talk?
Don't worry. Remember, you have more control over your stock taxes than you think. Just by learning about the rules and using the right tools, you can keep more of your hard-earned money.
So empowering.
It is.
All right, everyone, we'll be right back with even more tax-saving strategies. Stay tuned.
Can't wait. Okay, so more strategies to maybe minimize those stock taxes.
Yes, please. More strategies.
We've already hit on holding those stocks for the long haul and that clever tax loss harvesting.
Right.
But there's even more.
Oh, good.
Before we get too deep, though,
Yeah.
can we go back to tax loss harvesting for a sec?
Yeah, absolutely.
I think, the sources touched on it, but some more examples could be really helpful.
Totally. Yeah.
It could be a little counterintuitive.
How so?
You're intentionally selling at a loss,
Right.
but those losses can actually offset any gains you might have,
Right.
potentially lowering your overall tax bill.
Just like making lemonade out of lemons.
Exactly.
Yeah.
But what if you still believe in a stock long term,
Yeah.
even though it's down right now?
Right. Doesn't selling kind of defeat the whole purpose of long-term investing?
That's a great question, and it's why it's so important to understand how tax loss harvesting really works.
Okay.
The key is to avoid that sneaky wash sale rule.
Oh, yeah, that rule.
Remember, you can't just sell a stock at a loss and immediately buy it back.
Right.
But there are ways to stay invested in a company,
Okay.
even while you're harvesting those losses.
Okay. I'm all ears.
So one way is to sell the stock that's down and then buy shares of a similar company,
Okay.
but not the exact same company
Got it.
in the same sector, though.
Okay.
So, for example, let's say you have a tech stock that's, not doing great.
Oh.
You could sell it, use those losses to offset gains, and then buy a different tech company, one that you think has better potential.
So you're still in the game.
Exactly. You're staying invested in the sector while still reaping those tax benefits.
That's clever.
Hmm.
Any other techniques?
Yeah, another common approach is to sell a stock and then buy a broad market ETF.
What's that?
An ETF is like a basket of stocks
Okay.
that tracks a particular index, so you're staying invested in the market as a whole,
I see.
but you're harvesting that specific loss on the stock that wasn't doing well.
So instead of picking another individual stock, you're diversifying.
Exactly. And that can be especially good for those who like a more hands-off approach.
Makes sense. Okay, so tax loss harvesting, got it.
Got it.
Let's talk about something I've been hearing a lot about. Strategically timing your stock sales.
Oh, yeah. Timing is everything.
Right. What's the thinking there?
Well, it's all about aligning your investment decisions with your tax situation.
Okay.
You want to sell stocks when you're in a lower tax bracket
Makes sense.
or spread out those sales over a few years.
To avoid jumping into a higher bracket.
That's it. So, like, when might it make sense to time those sales strategically?
Yeah, give us some examples.
Okay, well, let's say you're planning to retire soon.
Okay.
You'll probably be in a lower income bracket.
Right.
Might be a good time to sell some stock, take advantage of those lower rates.
So like sell when your income is lower.
Exactly. Especially if you're expecting a big payout from, say, selling a business or property.
So it's not just stock income.
No.
You got to look at the big picture.
The whole picture.
Got it. Any other scenarios?
Yeah, let's say you have a lot of stock in one company.
Okay.
Selling all at once could bump you up to a higher tax bracket.
Oh, right.
So spreading out those sales over time can help you stay in that lower bracket.
So it's all about managing that income flow.
You got it.
Okay, this is fascinating. We've been talking about pretty advanced strategies.
Oh, yeah.
Before we move on, though, the sources mentioned something called qualified small business stock.
QSBS?
QSBS, yeah. What's that?
Oh, that's a cool tax break.
Okay.
To encourage investment in small businesses.
I like that.
If you qualify, you might not have to pay any capital gains tax on that stock.
Really? No capital gains tax at all.
It's true. It can be a really sweet deal.
Okay, I'm listening.
But there are a lot of rules.
Of course there are.
First, the stock has to be from a qualified small business. There are limits on how big that business can be.
Okay.
And you usually need to have held onto the stock for at least 5 years.
5 years, wow.
There are also limits on how much gain you can exclude.
It's complicated.
It is. But potentially very rewarding. Definitely talk to a tax pro, though.
So QSBS, another tool in the toolbox, but
Definitely.
one that needs careful handling.
For sure.
Okay, so we've covered a ton of ground.
We have.
My brain is full.
I know, it's a lot to digest.
Let's shift gears a bit and get practical.
Good idea.
How do we keep track of all this information?
Oh, that's super important. You got to keep good records when it comes to stock taxes.
Right, of course.
Luckily, there are some tools that can help us out these days.
Like what?
Many brokerages now have built-in tools to track your cost basis.
Cost basis. Remind me what that is again.
It's the original price you paid for a stock, plus any fees you had to pay.
Right.
It's important for calculating your gains and losses when you sell.
I see. So these tools are basically like our personal stock assistants.
Basically, yes.
Yeah.
But it's still a good idea to keep your own records, too.
Just to be safe.
Exactly.
Yeah.
What's your preferred method?
Well,
Spreadsheets. Shoeboxes.
maybe not shoeboxes. I like spreadsheets. Nice and organized.
Perfect. Make sure to include the date of each transaction, number of shares, price, any fees.
Okay.
You can even add notes about why you made that trade.
Ooh, good idea.
So good record keeping, key to staying organized. But even then, there's still the whole filing your taxes part.
Oh, yeah, the dreaded tax filing.
It can be a bit daunting,
It can.
but there's help out there.
Oh, good.
The IRS website has tons of information.
Oh, yeah.
And there are tax software programs that can walk you through everything.
Step by step.
And if you're feeling lost or your taxes are complicated,
Yeah.
talk to a tax professional.
Great advice. Even with all that help, there's still a lot of tax jargon to deal with.
There is.
Can you give us a quick rundown of the key tax forms we'll probably see?
Sure. The main ones are Form 8949, that's where you list all your stock sales,
Okay.
and Schedule D, that's where you summarize all your capital gains and losses for the year.
So Form 8949 is like the itemized list, and Schedule D is the big picture.
That's it. And tax software can usually help you fill those out.
Awesome. Okay, so tax time might not be fun.
Nope.
But with some planning and the right resources.
Doesn't have to be a nightmare.
Exactly. Okay, this deep dive has been so insightful.
It is.
We've gone way beyond the basics.
We have.
Before we wrap things up, any final thoughts for our listeners on what we've learned?
I think the most important thing to remember is that you have more control over your stock taxes than you might think.
Yes.
By understanding the rules, planning ahead, and using the right strategies.
Yeah.
You can keep more of that money you work so hard for.
That's a great message to end on. But before we sign off, one last thought. This is just the start of your journey as an informed investor.
Oh, absolutely.
Keep learning, keep asking questions.
Yes.
And don't be afraid to get advice from a professional.
Couldn't agree more.
Wow, we really went deep on stock taxes, huh?
Yeah.
Capital gains, ISOs, tax loss harvesting. It's been a lot.
It has. But it's fascinating stuff, you know?
Uh,
The tax code, it's not just numbers.
it's not.
There are real economic and societal values reflected in those rules.
Oh, interesting.
And when you understand that, it makes more sense.
I see, yeah.
You can make smarter choices.
Yeah, for sure. Like how we were talking about the lower tax rates for long-term gains.
Right.
That encourages us to be patient, you know?
It does.
Invest for the long haul, not just quick profits.
Exactly. It helps stabilize the market, too.
Right. And what about those tax-advantaged accounts? They're not just about retirement savings, right?
Bigger than that.
It's like the government's encouraging us to, like, invest in our future.
We like that, yeah.
You know, health, education, all that.
And they give us tax breaks to help us along the way.
It's like we're all in this together.
Yeah, working towards a more secure future.
But still, with all these rules, it can be tough to know where to begin.
What resonated with you the most?
I think the biggest thing for me was realizing that taxes aren't just something you deal with once a year.
Oh, I like that, yeah.
You have to think about them with every investment decision you make.
That's true.
Whether it's picking the right IRA or deciding when to sell a stock, those tax implications, they really matter.
You're totally right.
It's about being proactive.
Yes. Instead of just reacting to that tax bill,
Right, exactly.
you're in control.
I feel like I've leveled up, you know?
We have
It's not just about gut feelings anymore. It's
Yeah.
about strategy.
being informed.
That's where the value is, right?
Absolutely. It's not just
Uh-huh.
about memorizing rules.
Right.
It's about understanding the system
So you can make smart decisions.
that work for you.
I feel empowered. But this is just the beginning, right?
It is. The financial world is always changing.
The tax code too.
Always. So keep learning
Stay curious.
and don't be afraid to ask for help.
That's great advice. We've got tons of resources on our website.
Check those out.
And as always, talk to a financial advisor for personalized advice.
Oh, they can help you make a plan.
Well, folks, that's our deep dive into stock taxes.
We covered it all,
We sure did. We hope you learned a lot.
and that you feel more confident now.
Ready to take on those stock taxes?
Strategically.
Happy investing, everyone.
See you next time.